$38 trillion. That is the hard number on America's ledger right now today. We aren't talking about next year or some forecast. That is the actual debt on the books as of December 2025. And if you are under the impression that figure is just background noise, you need to lock in on what I'm about to say. While you are distracted by your social feeds and binge-watching streaming series, the planet's biggest financial powerhouses began a maneuver unseen for 75 years. They are shifting capital, colossal volumes of wealth out of dollar-backed holdings. They're doing it quietly, methodically, and away from the front pages. This is not some fringe conspiracy. This is verifiable capital flight based on public records and treasury data you can fact-check yourself. By the time we finish here, you will grasp exactly what is unfolding, the reasons behind it, and critically what happens next. There is a historical algorithm at work here, a mathematical sequence that is executed 3 times in the past 500 years. Identical phases, identical red flags, identical catastrophic endings. We are watching it replay right now. The only uncertainty is if you will spot the freight train coming or be left wondering like millions before you, how you missed the warning shots. Stay focused because the next 15 minutes will permanently alter your financial worldview. Global debt has smashed through the $251 trillion mark per the latest IMF figures. That represents 235% of worldwide GDP, the highest ratio ever seen during peacetime. American debt alone rocketed from $36.1 trillion in January 2025 to $38.4 trillion by December. That is a $2.3 trillion spike in just 11 months. But here's the secret no one is sharing. This exact script has played out before, 3 separate times in the modern era, and in every single instance, the nation holding the global reserve currency imploded within 36 months of the institutional money exiting. Not a rough patch. A total system failure with identical patterns, identical timelines, and the exact same result. The cycle is mathematical, predictable, and virtually unchangeable once it crosses a specific threshold. Let me break down the mechanics. Every major financial empire collapse over the last 5 centuries adhered to a strict 4-part sequence. Phase 1, the rise. A nation establishes itself as the financial hub. Cash floods in from every corner of the globe. Their currency becomes the bedrock of international commerce. Everybody buys in. Banking explodes, markets rally, technology leaps forward. Horizons seem endless. Confidence is unshakable. This era typically spans 50 to 80 years. Phase 2, the overreach. Dominance creates hubris. The state begins spending cash it does not have. Larger armies, overseas conflicts, social safety nets, all paid for with credit. Debt outpaces growth, yet panic is absent because asset values continue to climb. Housing soars, equities smash records. The population feels rich. Central bankers keep the printers running to sustain the illusion. This period lasts 20 to 40 years. Phase 3. The quiet exit. This is the danger zone. Smart capital spots the cliff edge. We aren't talking about the general public or lawmakers, but the folks who actually analyze the ledgers. Big players begin rotating wealth out. No press conferences, no headlines. Just a methodical shift into secure harbors. Foreign entities trim their positions. High net worth dynasties spread their risk across borders. The trickle starts slow, then accelerates. This window stays open for 18 to 36 months. Phase 4. The crash. The currency is stripped of its reserve. Title. Overseas banks liquidate. Inflation goes vertical. Rates skyrocket, markets tank all at once. Banks collapse, retirement funds vanish. The middle class is wiped out. Political turmoil erupts and everyone asks the same question. How were we blind to this? The reality is the signs were always visible. Let's validate this with history. 3 superpowers, 3 dominant currencies, identical cycles, identical endings. The 1500s, Spain, the undisputed heavyweight champion of the world. No rivals, no contest. Spanish galleons arriving from the Americas hauling more gold and silver than humanity had ever witnessed. The Spanish real was the king of currencies. If you wanted to do business, across borders you operated in reals. Madrid was the financial capital. Phase 1 locked in. King Philip II ruled half of Europe. Spanish. Legions were invincible. His navy dominated the oceans. Riches flooded in from colonies spanning 3 continents. And the result? They blew it all. Wars against France, England, the Ottomans, the Dutch. A military footprint stretching across the globe. A government machine that burned through treasuries, palaces that cost entire fortunes, and an inquisition that incinerated capital alongside heretics. By 1550, state expenditures hit 300% of income. They spent triple what they earned. The deficit was covered by loans from Italian bankers and German traders. But because New World gold kept arriving, anxiety was low. Spanish assets appreciated. People felt wealthy. The empire looked untouchable. Phase 2 confirmed. Then the tide turned silently. 1555, major Spanish banking. Dynasties began shifting wealth to Genoa. The Fugger Spain's primary lenders demanded gold payments rather than promises. They wanted out. By 1556, rich traders moved operations to Amsterdam. Not a sudden jump, but a gradual process. Opening branches, moving stock-changing trade. Roots. The reason they analyzed the books. The data showed Spain was effectively insolvent. The crown was paying 40% interest on loans. 40% isn't strength. That is the scream of desperation on a balance sheet. Phase 3 verified. 1557 Spain defaulted. Credit froze instantly. Bonds went to zero overnight. The crown confiscated private gold shipments to pay the troops. Financial panic set in. The king insisted it was a blip, a temporary issue. Everything would be fine. 1560, Spain defaulted again. 1575 again. 1596 again. 1597 again. 4 crashes in 40 years. The currency died. Inflation gutted the populace. Spain's dominance vanished into thin air. By 1600, the empire was a hollow shell. The glory days were gone forever. It never recovered. Phase 4. Complete. Where did the capital migrate north to the Dutch Republic? Amsterdam took the crown. This leads to case study 2, the 1600s. Amsterdam undisputedly the wealthiest city on earth. The Dutch East India Company held a value equivalent to $8.28 trillion today. Bigger than Apple. Imagine taking the market caps of Microsoft, Amazon, and Google, doubling them and rolling it all into one nation. That was the Dutch dominance. The guilder wasn't just money. It was the asterisk money. If you were doing business across borders, you used Dutch currency. Full stop. Wealth poured into Amsterdam from every corner of the map, Africa, the Americas, and all over Europe. Smart capital, hunted for yield, and it nested in Dutch vaults. Picture the Dutch Republic in the 1600s as Silicon Valley Wall Street and the City of London, squeezed into a single square mile. Now I can hear the gears turning in your heads. Where is this guy pulling these stats from? Fair point. But listen, every single data point here is backed by official records. We're talking the Treasury, the IMF Congressional Archives, it's all verified, and I've dropped the links below. Go look for yourself. That's stage 1, absolute supremacy. And the fighting started. It's always the fighting, isn't it? 3 brutal Anglo-Dutch conflicts between 1652 and 1674. Scuffles with France, battles with Spain. The Dutch military footprint spanned from Indonesia to Brazil all the way down to South Africa. That kind of reach burns cash, serious cash. National debt exploded from 4 million guilders in 1650 to 80 million by 1690. That is a 20-fold spike in just 40 years. Their solution? Fire up the printers. Ringing any bells yet? At the same time, tulip mania took hold. People were swapping actual houses for flower bulbs. One rare bulb could run you 10 times what a skilled craftsman made in a year. The price of assets completely divorced from economic reality. Everyone felt rich on paper. Meanwhile, the Bank of Amsterdam, supposedly the rock-solid vault of Europe, was quietly backdooring customer deposits to fund the government's wars. They were playing fractional reserve games before the term existed, a classic hustle wrapped in a suit and tie. Stage 2, complete. By 1690, the smart money saw the writing on the wall. The big banking dynasties began shifting their operations to London. The Sephardic Jewish merchants who built Amsterdam's fortune started packing their bags. Portuguese traders set up shop in England. German capital slowly but surely bled out of the system over the years. Why? Because the insiders knew the truth, the public didn't. The Bank of Amsterdam was insolvent. They'd been broke since 1672, using new cash to cover old withdrawals for decades, textbook Ponzi mechanics. They kept the lid on it until the pressure blew. Stage 3 confirmed, 1795. The French Revolutionary Army marches in. The Republic crumbles. The guilder becomes worthless. The bank's fraud gets blown wide open. Regular people lost everything. You had riots, political meltdown, total chaos. The Dutch Golden Age didn't just fade, it snapped. 150 years of power gone in a heartbeat. Stage 4 is in the books, so where did all that wealth go? It crossed the channel to London. Britain was the new king. The wheel keeps turning, which brings us to case study number 3. This is the big one, because it's the freshest. The blueprint that mirrors exactly where we are today, the 1700s through the 1900s, the British Empire. The empire on which the sun never sets. You know the phrase, we all do. At its height, Britain ruled 23% of the global population and a quarter of the planet's land. The pound sterling held the crown as the world reserve currency for more than 200 years, a run longer than any modern rival. The City of London was the beating heart of finance. You needed funding. You went to London. British bankers paid for American railroads, African mines, Asian plantations, and infrastructure projects across the globe. More than 60% of world trade was settled in pounds. The entire gold standard revolved around sterling. Their power felt infinite, untouchable. Stage 1 total control. But then came the 20th century and two massive global conflicts. World War I put Britain in the hole for $44 billion. In today's money, that is over $600 billion. They borrowed from the Yanks, from their own people, from anyone with cash. National debt skyrocketed from 30% of GDP to 130%. Memorize that number, 130%. That is exactly where the United States sits right now. They fought to keep the gold standard, collapsed in 1931, tried to fix it, collapsed again in 1933. The gears were grinding to a halt. World War II just poured gas on the fire, more debt, more money printing, more empty promises. Britain won the war on paper, but financially they were obliterated, broke, surviving on American lifelines. Stage 2 check. By 1949, the silent evacuation was underway. Major British firms started shifting their headquarters to the States. Unilever, Shell British Petroleum, they didn't close up shop, they just moved the money, redirected the capital, and built their future elsewhere. The wealthy families moved their hoards offshore to Switzerland, the US, Canada, anywhere that wasn't the high-tax, regulation-heavy sinking ship of Britain. The brain drain kicked into high gear. Scientists, engineers, business builders, professors all booking one-way tickets to America. Britain promised high taxes and zero growth. America offered the sky. It wasn't a hard choice. By 1960, foreign investment in the UK had tanked by 62% compared to pre-war numbers. The cash fled, the talent fled, the future fled. Stage 3, done. 1967, the pound gets devalued by 14.3% overnight. You wake up one morning and your money buys 14% less. The government had their back against the wall. They burned through their reserves trying to prop up the currency. It was game over. 1976, Britain goes to the IMF effectively begging for a bailout. A bailout. The former ruler of the world, the empire that owned the map, forced to ask for emergency loans like a struggling startup. Total humiliation. The pound lost its reserve status. Global trade switched to the dollar. Britain's financial century was officially dead and buried. Stage 4 verified. 3 superpowers, 3 reserve currencies, covering 500 years. The same 4-stage cycle, the exact same result. Spain, the Dutch, the British, they all walked the same road from glory to the graveyard. Now let me paint the picture of why America is deep in stage 3 right now. 1944, Bretton Woods. The dollar takes the throne. It's backed by gold at $35 an ounce. Everyone else is backed by the dollar. The system goes live. America walks out of World War II victorious. Europe and Asia are rubble. Capital floods into the US. American markets become the deepest, most liquid pools of money on the planet. The world is hungry for US assets, stocks, bonds, real estate treasuries. The American Golden Age kicks off. It runs from 1945 to 1971, 26 years of unquestioned power. Stage 1 is in the bag. 1971, August 15th, Nixon slams the gold window shut. The dollar becomes pure fiat. No gold, no silver, nothing but a promise and a handshake from Uncle Sam. Just trust. And what happens? When the guardrails come off, spending goes vertical. 1980, the national debt hits $900 billion. Sounds like a lot, but look at the trend. 1993, trillion. 2005, 0.6 trillion. 2008, 10 trillion. 2020, 27 trillion. January 2025, 36.1 trillion. December 2025, 38.4 trillion. That is a 4,200% spike in 45 years. Within a mere 5 years, that figure ballooned to double its size. However, sovereign obligations are merely the tip of the iceberg. Looking at the corporate sector, leverage has swelled to $13.5 trillion. Families are drowning in $18 trillion of household liabilities. Student loans account for $1.77 trillion, while credit cards stack up another $1.1 trillion. Auto financing sits at $1.6 trillion with medical bills, adding hundreds of billions more. When you tally every ledger, total United States liabilities exceed $100 trillion. That represents a staggering 370% of our GDP. For perspective, Spain went bust at a 200% ratio. The Dutch Republic fell apart at 250%. The British Empire surrendered its reserve currency crown at 130%. Yet here we are, climbing past 370%. How do we manage the vigorish on that? The Treasury is now shelling out over $1 trillion annually just to cover interest. Charges. That sum eclipses the entire defense budget, surpasses Medicare, and outstrips the operating costs of most federal agencies combined. $1 trillion, purely for debt service. Not a penny goes toward principal reduction, just servicing the juice. So where does the cash come from? They fabricate it. The M2 money supply vaulted from $15.5 trillion in February 2020 to $21 trillion by April 2022. That is a 40% spike in just 26 months. It stands as the most aggressive monetary dilation in the annals of American history. The result? Rampant inflation, speculative asset bubbles, and a widening chasm of wealth inequality. These are the textbook symptoms of Phase 2 equity markets hitting record peaks, while purchasing power for the working class stagnates. Valuation metrics, like price-to-earnings ratios, are flashing warning signs at bubble altitudes. Real estate values have surged 73% since 2019. The inflation is systemic. Every single asset category is trading at premium valuations simultaneously. The Federal Reserve expanded its balance sheet from $800 billion in 2008 to a colossal $9 trillion in 2022. They purchased everything in sight. Treasuries, mortgage-backed derivatives, corporate debt, all to prop up asset. Valuations through artificial support. Phase 2 is finished confirmed by the math. Now the narrative shifts to Phase 3, the Great Migration. Back in 2013, Beijing held upwards of $1 trillion in U.S. treasuries. Today, that hoard has shrunk to $760 billion. They have offloaded more than $300 billion over the last decade. This is all in the public ledger. Japan, formerly the top foreign creditor, has trimmed its exposure by $220 billion since 2022, quietly selling off paper month after month. The Saudis are divesting. Belgium is cutting its stake. Switzerland is selling. France is stepping back. Even the Federal Reserve is slimming down its own portfolio through quantitative tightening. They are allowing bonds to reach maturity without rolling them over, effectively sucking liquidity out of the financial plumbing. So who is left to buy American debt? Primarily the U.S. government itself, the central bank and public pension funds. It is a snake eating its own tail, printing fiat currency to purchase your own liabilities. That does not signal strength. It screams desperation. And this trend extends beyond sovereign entities. The titans of finance are reallocating capital. BlackRock, the heavyweight champion of asset management with $10 trillion on its books, has overhauled its strategy, slashing U.S. Treasury exposure while boosting stakes in emerging economies, European infrastructure projects, Asian property markets, bullion, and raw commodities. They're diversifying to escape the dollar concentration trap. JP Morgan has reworked its institutional bets. Goldman Sachs is cooling on U.S. equities. Morgan Stanley is advising clients to look internationally. Bridgewater Associates has been sounding the alarm regarding currency debasement for years and has hedged its bets accordingly. The smart money is heading for the exits exactly as they did in Madrid, Amsterdam, and London before the fall. Checkmate. Phase 3 is locked in. Let me walk you through Phase 4. If we follow the historical trajectory and the mathematical certainty, the greenback will slowly forfeit its title as the global reserve standard. It won't vanish overnight or via a press release. It happens gradually and then all at once. Nations begin conducting commerce in alternative mediums, the yuan, the euro, or direct bilateral. Swaps that cut out the dollar completely. The shift is already in motion. Brazil and China are transacting in yuan. Russia and India are settling accounts in rupees. The BRICS bloc is engineering independent payment networks. Economies, representing over 40% of global GDP, are constructing the rails to trade without touching a single dollar. Here is a crucial detail. In June 2024, headlines claim the petrodollar pact had died. Let's clarify the reality on the ground. The 1974 U.S.-Saudi Commission on Economic Cooperation did expire, but fact-checkers verified there was never a binding legal contract mandating Riyadh to price crude exclusively in greenbacks. It was a handshake deal, a strategic understanding. However, and this is the vital part, the kingdom has recently signaled it is open to accepting other tenders for its oil. They have piloted transactions in UN. The net result is identical. The dollar's stranglehold on the energy trade is slipping. The petrodollar regime is fracturing, albeit at a slower pace than the clickbait suggests. When global demand for dollars dries up, what becomes of those trillions stockpiled in foreign vaults? They flood back home, drowning the domestic economy. That is the moment inflation goes vertical. The Fed will be cornered, hike rates to the moon to kill inflation, which renders the $38 trillion debt unserviceable and nukes the economy, or keep the printers running, which annihilates the currency via hyperinflation. Both roads end at the same cliff. Asset values collapse as liquidity evaporates. Stocks, bonds, property, everything reprices downward in unison. Banking institutions fail, pension funds go belly up, insurers fold, the dominoes start falling, and the middle class, with their wealth locked in, fiat and dollar-denominated paper gets completely sheared. Savings turn to dust, retirement nest eggs vanish, home equity is erased. This is not a theory. It is a historical cycle. It has played out every single time without fail. I know the objection, but America is exceptional. We possess the mightiest war machine ever built, cutting-edge tech elite universities, and the most dynamic corporations. This time is different. Let me remind you what history actually teaches. Spain fielded the most dominant military in the 1500s. It did not prevent economic ruin. The Dutch boasted the supreme financial tech of the 1600s. They pioneered modern capitalism, stock exchanges, central banks, and options markets. It did not stop the crash. Britain commanded the vastest empire known to man, fueled by the Industrial Revolution, a global navy, and unrivaled trade routes. The sun never set on them, yet it did not stop the collapse. Kinetic power cannot defeat economic arithmetic. Technology cannot halt currency dilution. Innovation cannot outrun fiscal madness. Exceptionalism is merely the bedtime story empires whisper before they crumble. But the Fed can print forever. They won't let it fail. They printed to infinity in Weimar Germany. Hyperinflation pulverized the middle class. Savings became trash. A wheelbarrow of cash could not purchase a loaf of bread. They printed in Zimbabwe. $100 trillion bills became worthless souvenirs. They printed in Venezuela. Inflation skyrocketed. 1,000,000% inflation. You see families hunting stray animals just to feed themselves. You see PhDs and attorneys driving ride shares to scrape by. We watch the printers run hot in Buenos Aires. We've seen currencies reset over and over. That's decades of misery in lands that should be rich with resources. Firing up the printing press doesn't generate prosperity. It's a mechanism for theft, shifting buying power from the prudent saver to the debtor, from the laborer to the asset owner, from the working class to the financial aristocracy until the public trust snaps. That's when the crash goes vertical. Every superpower assumes they are the exception. Every global reserve currency operates under the delusion of permanence. They are dead wrong every time. The economic cycle is indifferent to your political narratives. It doesn't ask for a hall pass. It doesn't wait for a majority vote. It plays out with the precision of physics, like cold hard math. And right now, every dashboard is flashing red for phase 3. So what's the play for your wallet starting this morning? First off, if your net worth is tied up in dollar-based paper assets, you aren't just vulnerable, you are the target. Spreading your bets is no longer a luxury. It is a survival requirement. Look for stores of value that stand firm when fiat crumbles. The yellow metal has preserved purchasing power for 5,000 years across every known society. Silver industrial commodities, tangible things that a central banker can't conjure up with a keystroke. Second, get some geographic distance. If the whales are moving capital overseas, take the hint. You don't need to move every dime, but hedge your bets. Investigate solid foreign monies like the Swiss franc, the Singapore dollar, or the Norwegian krone. Distribute your political risk across different maps. Third, master the timeline. This third phase is finite. Looking back, these periods usually run 18 to 36 months from open to close. We are likely sitting at month 12 or 15, based on the acceleration of foreign dumping. That gives you a runway measured in months, certainly not years. Move smart. Fourth, boost your liquidity. Keep some dry powder ready. I know inflation nips at it, but in a meltdown, liquid capital gives you the power to strike when asset prices floor. Being illiquid becomes a prison exactly when you need to run. Fifth, slash your liabilities. High leverage in a rising rate market is a death sentence. If you are leveraged to the hilt to leverage today, every basis point hike ramps up your service costs, and the trajectory for rates is only going up from this point. 6, double down on your brain and your circle. The ultimate hedge against collapse is human capital. abilities that generate worth, expertise that fixes problems, and alliances based on loyalty. These can't be debased or confiscated by the state. Seventh, stay plugged in. The survivors of these upheavals are those who spot the storm clouds early, who recognize the rhythm, and don't rely on cable news to validate what is blatantly obvious in the numbers. Smash that subscribe button. Click the bell because the upcoming video breaks down precisely which investments have historically rallied during fourth stage collapses, which ones acted as a shield against superinflation, and which ones were wiped out. I will walk you through gold's price action, when the British Empire crumbled, what happened to property values when Spain defaulted, and how stocks reacted during every great currency crisis. The history books show the same loop. If you know the steps, you can position yourself to win. I'm not here to spread fear. This is about recognizing the setup. We have 500 years of financial records demonstrating this identical loop on repeat. America's debt stack hit $38 trillion for a reason. Overseas central banks are offloading for a reason. Major funds are diversifying for a reason. They are seeing the exact same blueprint you just learned. The same blueprint that dismantled Spain, that ruined the Dutch Republic, that finished Britain. We are living in stage 3 right now. It is the capital flight era, the silent evacuation. The smart money is already walking out the door. The red flags are flying if you are paying attention. Phase 4 is approaching. The arithmetic is unavoidable. The only uncertainty is whether you'll be ready when the hammer drops, or if you'll be asking, like countless others in history, how you were blind, when the warnings were right under your nose. The intel is here, the pattern is distinct, the statistics are verifiable, the move is yours. Leave a response below, share your take your game plan, or tell me where you differ. I read every single entry. Hit subscribe now, because the next upload exposes 3 specific market sectors that historically surge during currency meltdowns. Sectors that could shield your fortune, or even position you to profit from the chaos. You don't want to sleep on this. The pattern is indifferent to your belief system. It doesn't need your faith. It doesn't require your permission. It simply executes just like every time prior. Thanks for the view. And keep in mind the winners in these transfers aren't always the ones with the deepest pockets. They are the ones with superior intel and the nerve to act on it. Winning during an economic reset is not about starting with a mountain of cash. It is about having superior market intelligence and the sheer conviction to act on it,